Hi, good afternoon. Welcome to today's First Financial Forum webcast. Today we're talking managing risk, maximizing value in your loan portfolios. We got a great session ahead for you today, featuring some insights on managing your portfolio risk, loan sale pricing trends, due diligence processes, and all different types of loans that are being sold in the market today. We're going to dive into some key topics about the current landscape for commercial real estate loans, how banks are managing the risk and dealing with these regulatory pressures, how some debt acquisition firms are navigating the complexities of their loan sale processes. We're going to touch on the impact of pricing trends, the role of due diligence, discuss how the market conditions are evolving. And then as we look into the next 12 months, we're going to explore what different types of loans are likely to potentially come to market, what factors and will shape pricing and deal flow in the near future. My name is Jamie Hook. I am the EVP here at FFN. It's my honor to be your host for today's discussion. I'm joined today by two distinguished guests. I've got Bob Coradi from Orrstown Bank and Brad Boyd from Midwest, both of which bring a wealth of experience in commercial lending and portfolio management and portfolio sales. Bob, I've known for many years. We first began doing some portfolio transactions with him. We've moved and transitioned into some more strategic transactions. He is the Chief Risk Officer at Orrstown Bank and brings over 37 years of banking experience into our discussion today. He's got a deep expertise in commercial lending and obviously dabbles in some portfolio sales with us. Spans across multiple roles within the bank, and obviously had a good hand in many of the bank's activities as it relates to their acquisition of People's Bank, and it's going to bring some perspectives on risk management and strategic asset management today. Brad Boyd, been in the industry for 26 years. So Brad and I, careers have overlapped for much of that time frame. He is a team lead at Midwest. He evaluates and underwrites and prices loans within the secondary market. He's been associated with the acquisition of a little over $4 billion in assets that crosses multiple sectors: real estate, C&I, rolling stock, et cetera. He's got some global experience as well, working outside of the U.S. and Asia and Mexico in particular, and has a deep understanding of secondary market dynamics. So for today, right, when we're thinking about talking through the markets, I mean, what better way to understand some of these complicated topics, what can be complicated, than to get perspectives of a seasoned community banker and an active, experienced loan buyer. So Bob, Brad, welcome, and thank you for joining us today. Let's jump in. Let's get started. Bob, we're going to start with you. We're going to talk about some portfolio management here to start. So start us off, Bob, if you would. Like, what are some of the key areas of risk management that you're focused on at Orrstown? And if you would, maybe even weave in kind of some thoughts of how you began bringing in some of the assets from People's Bank and how that might have influenced your approach on managing some of these risks.
Well, yeah, sure. Thank you, Jamie, and it's a pleasure to be here. So yeah, we've Orrstown's been engaged in loan sales now for the last 12 or 14 years. I've been with the bank for 12 years, and we went through a period back during the financial crisis where we really had to we had to create liquidity and dispose of some significant level of problem assets. And we went through and did that in several loan sales back in 2011 and 12, and that went well for us. Obviously, we knew at that time that we had most of them were real estate loans that had not performed well. So at the time they were really relatively heavily discounted. We had taken charges. Since that time, we've engaged, as I think you would call it, a little more strategic, in a little more strategic manner with loan sales, and it's typically happens. We really look at the number of accounts that we're managing in our special assets unit. we look at what the workflow is there, and we make a determination really if, depending on how we reasonably look at a credit and whether it's worth holding on to for a couple of years to bring it, possibly to rehab it, or is it one that may take that long to work out even at a discount. So then the question becomes, gee, if we would pull that forward, and could we really put the capital to better use by selling the asset now? And it's no different with our acquisition now with People's Bank. We had a couple of two small acquisitions in 2019, and we actively deployed this strategy and sold some of our assets. And I'll tell you the way we went about it. With these acquisitions, you set marks on the credits, and what we were able to do for the most part was sell the assets at we got greater pricing than the net carrying value we had on our books due to the credit and interest rate marks we had. And so we're looking at the book now. We've had some downgrades, and we've got a few credits in the loan sale now, and we'll consider that, continue to consider that as an option.
Excellent. Thanks, Bob. Hey, and Bob, I want to stay with you here for just a moment. So a number of articles read and some many opinions as it relates to some CRE concentration ratios, right, within the bank, and that gold standard, if you will, or the status quo of being above or below the 300 mark. We visited with many community banks that are well over the 300, and they're not concerned about it. So what's your approach, and what's the metrics that you're trying to work with at Orrstown? I think you're a little north of 300 currently.
We are.
What are your thoughts there?
Yeah, we're at 330 currently, and we actually discussed it with our regulators, and they were comfortable with us going slightly over 300. Our current policy allows us to go to 350. And the discussions we've had with them have been along the lines of having the proper portfolio management in place to monitor the portfolio, in particular to be able to generate reporting with all the data points. What's the average loan to value for your portfolio? What's your debt service coverage? You monitor your covenants and all of that. Yeah, and then the last part of your question, Jamie, I'm sorry, I just.
Oh, I was just curious. I think you've answered it. I mean, I think I was just kind of getting your take on, how you were reviewing that CRE concentration ratios and what your targets were. I think you've addressed
Sure.
both of those.
Yeah. The other point I would add is that both Peoples and Orrstown we were right at 300, maybe 302. Peoples was actually below that, but with the acquisition, it was a merger of equals. It was a bank very close to our size. Due to the purchase credit marks and the hit that those marks apply to our capital, or risk-based capital, it caused our CRE concentration level to go up to 330. So.
Got it.
So that's an interesting point, and so we're working on managing that now, and not necessarily looking at we're not looking at any wholesale moves to move credits out of the bank, but we are looking a little more strategically at what we want to bring in at this point.
Okay, excellent. Thanks, Bob. So Brad, let's bring you into the mix here. So when you're hearing about the concentration risk that Bob's focused on at like an Orrstown, how, from your perspective, as an acquisition firm, like when you're targeting your portfolios, how much are you considering where Bob's kind of spending his time in terms of managing that risk? Does it play any factor for you, or are you kind of setting your own prioritization in terms of your targets?
Really, We have a national target. We're not bound by any sort of real concentration risk. However, we do recognize it within our portfolio if we're buying a lot of multifamily, say in the Southeast, or office in the Midwest. You know, obviously you take a look at that when you're looking at future potential acquisitions. But company-wide, yeah, we look at anything across the US and in Puerto Rico. Most of the assets we look at are small balance, meaning $10 million or less. However, recently this year, as everyone knows, you know, office is the has had some issues. And so we've actually emerged into the middle market sector of the industry and looking at office and have actually transacted on a couple of them. So concentrations, not necessarily, we recognize them, but are not bound by, oh, we can't look at that.
Okay. And you said one of the dirty words there for the market right now in office. So Bob, maybe touching base back with you. Like, are you experiencing any pressure from regulators or examinators, some of your best friends there, to address like specific types of assets in your portfolio, some office, some hotel, or others that might be on your books? And if so, how are you managing through that?
Yeah, I mean, fortunately, that's an area where we do have an office portfolio. We have a hospitality portfolio, but we're fortunate in that our office portfolio, while it's fairly substantial, we do not have a significant exposure in major metro markets. We're in the suburban markets. And I know every banker, probably likes to say that they deal with the highest level borrowers and sponsors, guarantors. But we've been fortunate there. We're in a good market, and we've had our CRE lenders have been doing it a long time, and we structure things rather tight, and so in the office side, we've not had any challenges or pushback, and again, principally because we're in the more suburban markets, and as far as the hotels go, we probably 10 years ago we really upscaled what we look at there in terms of the flags. And we again, the hotels that had experienced the most problems were the ones in downtown areas with convention centers attached to them. We don't have any of that. We have, we're located, along 81 and 83 and the East Coast here between Baltimore and Harrisburg and Philadelphia, and that has served us well. Mostly destination oriented type hotels. So we've done well there, and in particular the hotel industry. We've seen those properties do really well the last 2 years.
Okay. Brad, what do you say? I mean, we talked office, we talked hotels. Are there other observations that you got in terms of classifications of assets that you've seen offered in the secondary market? Any notable shifts that you've seen in maybe the last 12 months?
Yes, I mean, one of the interesting things, Jamie, that we've seen recently is, for instance, rolling stock.
Okay.
And that industry has seen some distress. And when I mean rolling stock, I'm talking like big busing companies, 18-wheelers, tractor trailers and trailers of companies of 50 trucks or less. We saw some of that this year, and we've transacted upon that. Another interesting thing that we've started seeing recently are hotels that are performing, that look to be in decent locations, However, they're somewhat functionally obsolete. And so you kind of look at that and you're going, okay, we have a performing loan. The LTV looks good. Why is the bank selling this loan? And some of it is the pit's coming up in a couple of years. What are we going to do there? Because we have a functionally obsolete hotel, meaning it's got some sort of banquet space in it that's underutilized. The other interesting thing that we're seeing are loans that are going to have some financial distress, in the next 6 to 12 months. And these loans were having trouble pre-COVID. Then COVID comes along and they receive PPP monies, and all the other government COVID programs, EIDL loans, things like that. So they've been carried on since 2020, and they've been able to make their payment. Everything looks okay, but the issue is you look at the balance sheet and all the COVID programs are gone, and you can see that cash start draining, and the issues have not been resolved. And so you've got this cash burn. So, you've got 6 months, 12 months left of cash. Then what do? We're seeing quite a bit of that.
Okay. Okay. Excellent. Excellent. Thank you. That's great feedback. All right, we're going to get into a moment here, thinking through kind of the components of a loan transaction and what might go into that and decisions that may go into that. One of the first questions that we always get asked at First Financial is, what's my loan worth? Right? I mean, if I am going to sell it, what is that going to be worth? And so one of the components that we like to focus on too is just talking about what that projection of pricing looks like and how that trend comes into being. I don't know that there's any better predictor of the future than looking at certain components of some historical aspects. And so one item I did want to share for today for the group is just looking through a little bit of some pricing data. In fact, I'm going to share out some information here with you. So this is a graphic of performing CRE and CNI loans. Axis here on the left being a ratio to par. Axis across the bottom is time. And so we're moving from 2007 through the 2Q of 2024. So a couple of observations just from a historical pricing perspective, and particularly for those that may be joining today that are not as familiar with the secondary loan sale market. These pricing components that you see built out on the screen here are segmented by industry type, right? Industrial, multifamily, office, retail, other CRE, and then all CNI in the gray line. And maybe the first observation that I'll point out is GFC occurs here in 2007. We take hits, they're across the board, and it's really close to a decade before prices begin to normalize, right? So for those who are the pessimists within the group who believe that we have some substantial discounts that may be coming down the pipe, observationally, I don't think there's I am not a subscriber to the concept that we're looking at another GFC, but any type of a turn always has a time frame before those prices begin to come back and normalize. So as you can see, a variety of pricing components that transition throughout roughly a decade. Into 18 to 19, we begin to tighten in terms of the pricing of various asset classes. And then, of course, 2020 comes along, COVID hits, a little bit of a dip, particularly in retail and hospitality type components. The gray line here is actually highlighting the variations in price that then occurred from CNI, right? Soft collateral that's associated. Since that point in time, you can see that many of the pricing components from 21 on have largely stabilized. There are exceptions in the market. We've touched on a few of those. Larger office components, particularly in the Northeast and in California. Hospitality had its day. It's not as big of an issue for us in terms of what we're seeing in the pricing components. The bigger component that I might touch on, you can't really tell it from this graph, would be that in 2024, our pricing has generally remained flat. The most noticeable observation, though, is that the variation in bids that we receive for these assets has begun to really spread, right? I know there's a lot of different aspects that go into determining what you're going to pay, or what secondary market is going to pay in terms of their cost of funds, their projections, their yield requirements. That has never been as broad for us in the last 9 months as maybe it has been in the last 5-6 years. So that deviation broadening in 24 has been an interesting component. And I'm going to transition us over here as well then to a non-performing table, right? So same basis, same figures. Obviously, we're starting at a lower point because these are non-performing, generally CRE assets. Again, our gray line at the bottom indicating those soft collateral or CNI. More variance. Your value for the non-performing assets is going to be much more heavily driven off of collateral values. So as those collateral values have shifted throughout time, those values have begun to, have varied and then begun to stabilize a little bit more again once we got past 19, 20, and then into the last couple of years. Categories that have remained generally strong would be any loans secured by industrial properties. Retail properties have priced very well. Offices in some smaller submarkets and in certain areas of Texas and Florida, for example. The questionable pricing and the anomalies that come through would be some of the office in central business districts in the Northeast, in California, multifamily properties, particularly those with rent stabilized conditions that are associated, and then some senior housing, which are a tough industry in terms of the regulations and the monitoring that's associated with those. So Bob, Brad, I guess before, and I'm calling on both of you, which I probably shouldn't do, but just before I move off of some of the graphics that we've got here in terms of pricing, any observations that you're seeing in terms of those charts, or any thoughts in terms of what you've maybe observed? In fact, let's start with you, Brad, I guess, in terms of just pricing maybe over the last several years, or any observations that you've got in regards to these charts.
Well, looking at the performing graph that you had up,
Mm-hmm.
and your discussion regarding the spread between bids, honestly, that's not too surprising. You're looking at cost of funds. You're also looking at portfolio overall. I mean, it's great to have performing loans in your portfolio that are consistent payers. However, the yields are low on those, so you need to balance your portfolio with a little bit more risk. So I would suspect that's why you see those huge variations in pricing. It's people adjusting according to what the balance of their portfolio, or you just have groups who have cost of funds that are too high to transact.
Yeah, and on that, Brad, what is the rate cut? I mean, recent rate cut, another quarter anticipated, I think, for this week. What impact, if any, does that have in terms of how that then flows through to the final prices that Midwest is willing to pay?
Honestly, it doesn't. Not a quarter point. It's not going to move the needle too much. It's not going to move the needle too much for your borrower either. I mean, if you've got a performing loan and it originated in 2020, you got a long way to go before they're going to move, unless they need to.
Right.
So a quarter point is not going to make that much of a difference, I don't think.
Okay, excellent. And these are, there's so many variables, so many components that can go into one of these. As a community banker in Bob's shoes, Bob, would have the best understanding of what he could do in terms of working out an asset, the time frame that's associated with that, the expenses that are associated with that. But one of the tools that I think we are able to provide as you're analyzing the process is again, what is that loan going to sell for? And so with a limited set of data fields and fairly quick order, we can return back a value and give Bob the tools, that price tool that he needs to make that final decision of what he wants to do and to move forward. And I will say too, if for any of you that are working, with a third party, with an advisor on that pricing, it's important for them to be realistic in that number, right? It does not behoove anyone in the process for them to give you a number that is not achievable. Setting a reasonable expectation on the front side is only going to enhance the proposition of you getting that asset sold at market value. And we don't like surprises in general in this industry. And so we're trying to set those expectations. And I think because we are realistic in those prices, that's why we have a 96% close rate on assets that we're taking to market, because we set those expectations in a reasonable and obtainable spot through a competitive transaction. Bob, I want to transition. I'm going to stop sharing here and bring it back over into the primary screen. So Bob, if you would talk us through the process. So at Orrstown, when you're evaluating a credit, you've got options, right? You can choose to work out that asset. You can choose to pursue foreclosure. You can choose to find a strategic loan sale process. Walk us through that process of how you're making some of the things that go into making the decision of how you're going to manage that problem credit. Bob, can you hear us?
I'm sorry, Jamie. I think I got the gist of your question. And
Okay.
What I would say is, we can look at it a couple of ways. So for example, I think the other bankers would understand when I talk about risk ratings. And sometimes you can have a performing loan that it's truly performing in that the payments are being made, and that's typically that has value in the secondary market. And the challenge sometimes is that maybe the customer has incomplete financials, low quality financials, or they have had a couple of bad years. There's been some deterioration, but they're able to continue making payments. And maybe that's a loan where you've even gone in and raised the pricing, maybe due to a covenant default or something like that. A loan like that typically has real value in these loan sales, and it's a way to essentially look at improving the quality of our portfolio. If we don't see it really has a good chance of being upgraded, we look out over the course of a year. Do we think that it's a good candidate for an upgrade? And if not, that could be one that could be presented in a loan sale, and many times with good pricing, because it's because payments are current. So yeah, that's what I would add there.
Okay. So in terms of, is there are there any ratios, or is there anything you're looking at, Bob, as you're reviewing that, of making the decision on let's pull the trigger on a foreclosure here versus let's move this into a loan sale? Is there a factor or a ratio that you're kind of honing in on when you're working through that process?
Yeah, I think that in particular for a real estate type loan, whether it's an owner occupied or not, or a non-owner occupied property, if the cash flow just isn't sufficient, the rental income isn't sufficient to cover all the debt and expenses associated with the property, and it's forcing us to keep the loan maybe at a substandard level, or even, heaven forbid, non-accrual. Maybe, they're behind on their real estate taxes. We look at that as the same way as a company that isn't making, or an entity that's not making its payments. So those would be and those would be ratios where debt service is less than 1 to 1, right? So that's kind of a general trigger, I would say.
Okay. And then, Bob, I'm going to stay with you one more time here. So, we've worked together, I know, on a number of different portfolio sales. We worked on single loan sales. I'm sure you're getting phone calls from the market, from different, groups who are ensuring you that, they're going to pay you top dollar if you'll just sell it directly to them. So why choose to work with a group like FFN?
Yeah. Yeah, well, I mean, clearly, I mean, you have you folks have been doing it a long time, and you bring a lot of parties to the table, and you introduce it's a competitive situation, right? And I can honestly say that it has always benefited us to go to your operation, and that we've always we have looked at scenarios, selling directly, and we say we get back the price, and we say, well, we better check that out, and sure enough, we get more. So I think that's really it in a nutshell, is that and with the extent of the inventory of your client, the number of clients you have people that are looking at different segments. So we feel pretty good that if we have a loan listed in your sale, that we're going to get the top dollar, because it's just not it's something we're not able to do on our own without that help.
Yeah. And that is a goal of ours is always maximizing value for our selling clients, while providing, a transparent process to our buying clients. So Brad, there's a wide range of loan portfolios that are available in the market. And clearly, you can make money even on the front side of how you're acquiring. So how are you making decisions on which deals to pursue and which deals that you're going to pass on?
Well, we look at a couple of things. One of them is, where are we in the marketplace? What does our portfolio look like? Where do we have a competitive advantage over others? It's no secret that Midwest is really strong in a balanced small portfolio of loans, of a mixture of real estate and C&I. It's kind of our bread and butter. Midwest is kind of a catch-all. We look at everything, so we have no specialty. So that helps us out quite a bit. We also lean on loan sale advisors as well. They will give us some input on portfolio pricing, on where they expect these portfolios to shake out at. Where's it going to be? And so we can look at it and go, okay, what's our best resource allocation? Are we going to be competitive on this, given the guidance? So that's where a loan sale advisor really helps out. To expound on what Bob had said, what's interesting about us is not only have we purchased loans from you, but we've also sold loans through FFN. And so it's really interesting to kind of see both sides of how it works. And I think one of the good things about working with a loan sale advisor is you do get that pricing up front on your portfolio. They have stats on pricing trends, so you kind of know whether you want to transact or not. On the buy side, looking at a portfolio through a loan sale advisor, you have certain confidence in that if you can get to the guidance, more than likely they will transact. Maybe not with you, maybe somebody will pay more, but there will be a transaction. So that's an extreme positive. From a seller side, another thing, and Bob talked about this a little bit, you vet the buyers. You know, it's real easy to have a buyer come in, they're the high bid, but guess what? You know, between that then and closing, they're scrambling trying to get the cash. And or, you know, your potential buyer is actually a broker themselves taking that loan out to market. That's the one thing that I see regarding using a loan sale advisor. You vet out your buyers, and you know, really you vet out the seller too. Are they going to sell this at this price or not? Because the due diligence, you know, there's an opportunity cost to what we do, and then there's a monetary cost to underwriting a portfolio, and it can get rather expensive. So you work on a portfolio that doesn't transact, the likelihood of you looking back when that group goes out to sell again, you know, you're going to kind of look around and go, okay, do we want to do this or not? So, you know, I look at that as benefits. The loan sale agreement, you know, loan sale advisor provides a loan sale agreement, so you don't have to go through that. At least you have a baseline agreement that you can work upon and work through and transact with. And so I think that's very helpful as well.
Yeah, we're a big believer in providing that sale agreement up front. That's a part of your diligence, is understanding that agreement, because we think when there's a bid, there's value in an understanding of what contract we're transacting under, as well as just the number, right? Brad, I will stay with you here for a moment. Talk to us a little bit from a due diligence standpoint. When you're reviewing the assets, what factors typically like improve the process, increase the value, versus what elements maybe that are missing are going to be the ones that really lead to discounts for you?
Well, I mean, from going from the easy to the most difficult, from an quote ops standpoint, if you will, having an organized loan package to review. It allows us to get through more of the loans. You know, you can spend more time because of this due diligence process has a beginning and an end. And there is no, oh, we need another week. You know, it's really funny. I talk to people and they always talk about deadlines, and very few industries have any true deadlines. They can extend them. This is an industry where there is no extension.
Yeah. You
have to get it done. So from an ops standpoint, an organized loan package really helps out. Financials. You know, if the seller has financials, provide them.
Hey, and Brad, how old are too old on financials? How recent do you want to see those?
I want to see them from yesterday. You know, 4 years worth of financials, most current interims.
Okay.
If your bank policy will allow it, it would be great to have current credit reports on the guarantors. Most recent appraisals. Don't, you know, you see some sellers, they have a recent appraisal and it may not be the value that they're wanting to show. So they give you a appraisal back from 2020 or 2018, 2015, and it doesn't matter. We're going to find out, we're going to establish our own value anyway.
Right. Right.
So being upfront and providing the information, even if it's negative information, will help a seller in the fact that when the buyer goes to roll this up or goes to credit committee, if you will, there's no questions as to what's going on.
Yeah.
Ambiguity leads to a lower price.
That's we have a similar phrase here. It is that people discount for the unknowns, right?
It's
If
very
there's a
true.
gap in the data, a gap in the documentation, people assume the worst and discount appropriately. So, Bob, I mean, you're at the forefront of providing that information. Talk to us a little bit about like how involved do you have to be in the process, right? As a community banker that's listening in, right? How much time should they expect to invest in this process? I mean, is it something that you're working on daily? Is it something you're hearing about weekly? If you could just kind of paint a picture as to what kind of requirements there are from your side.
Yeah, I would say from our side, we have. I think there's a little bit of work. There's a process to fill out a spreadsheet with the loan history, the loan number, number of times past due, that kind of thing. And we will upload. Typically, it would include our latest problem loan report. We have quarterly problem loan meetings, and our most current report has each prior quarter's narrative within the document itself. So, and that includes the most current spreads we have, and so we will upload all of that information in addition to the appraisal, and obviously when we're looking at just getting pricing, that's probably the extent of what we need to do. Then when we decide, yeah, this, based on the estimates we're getting back, we'd like to put this in the loan sale. We're also including some of the regular documentation, maybe a loan agreement, a lien searches, that type of thing. Anything that, I know that I, as a lender, would want to be able to make an informed credit decision.
Right.
Yeah.
Exactly. Right. So, Brad, there can sometimes, not always, but sometimes be a stigma associated with selling loans, right? That you're just there to buy it at fire sale prices. You're going to be super abrasive to all the borrowers that they're picking up. And I'm sure, as with any industry, there are some bad actors out there, but generally speaking, that's not been our experience. So talk to us a little bit about kind of just your approach, once you've acquired the asset, kind of what's your mindset and what's your approach with those borrowers in terms of that transition from, working with the bank to working with you.
Well, first, the last thing anybody wants to do is foreclose on a loan. It's time consuming, it's costly, and by the time you get your hands on the property, there could be all sorts of issues. So that is, I look at foreclosure, and that is a lose-lose proposition, not only for your lender, which could be Midwest or Orrstown, and the borrower too. And so when we go in and look at and acquire a portfolio, we're a workout shop. That's what we do. We work out loans. Some loans, performing loans that are extremely well secured, no near-term maturity, you sit them on the shelf for a while and collect the payment. You have a situation where you've got LTV issues and you have real debt service coverage issues. You work with the borrower to try to find a resolution that is amicable both for the lender and the borrower themselves. You know, no one's out to, no one's going to give away anything by any stretch of the means. But however, there are cases where you've got to work with the borrower, and that's the good thing about with a loan sale, selling on the secondary market is like Orrstown. You know, they may have a criticized asset. Well, they don't want that on their books, but it could be worked out. Well, that's where selling that loan on the secondary market allows you to sell that loan and let a group like Midwest or some other groups like us work them out that are not under any sort of regulatory issues or would have any regulatory issues.
Yeah. And Bob, from your perspective, clearly part of like, you know, our role in the transactions that Brad alluded to earlier is to vet through the buyers, to ensure that we're bringing qualified, sophisticated groups into the bidding process, so that you feel secure as you can in terms of transacting to that group. From your perspective, Bob, you know, what are your thoughts about, I mean, who it is you're selling to, and have there ever been any concerns in that regard from inside of Orrstown?
Well, Jamie, the only time we have concern about that is when we have a borrower near the end of the quarter who's telling us they've got a way to pay us off, and you know, maybe we're a little skeptical about it, and we're wondering if that's going to really happen. And you know, usually if we're concerned, there's a reason for it. But I can tell you that is, again, one of the reasons that, you know, we would consider a loan sale, you know, several loans, or even just one or two, you know, for an end of quarter period. We know that when your bidders are looking at our loans, they put in a bid, they sign on the dotted line, that they're very committed and they follow through. So it's not like something that you know, I'm going to have to where we've planned, right, to have that asset off the books. Our CEO, CFO has been involved in the process. They know what we're looking at. Where either it's, you know, whether it's a concentration issue or a classified loan issue that we're trying to work down. And, you know, that, hey, we want to be able to, you know, show the market, our institutional investors, you know, when we release earnings, you know, 25 days after the quarter end, hey, look where, you know, you saw maybe what you saw last quarter. You could see the improvement now. We don't want that to be in doubt, right? We don't want to have to, you know, have a situation where there were promises and then all of a sudden things fall through. And I think having a list of credible buyers is key to that.
Yeah. Thanks, Bob. That's helpful. I think, you know, from our perspective at FFN, part of what we're trying to provide, you know, to you, Bob, and present as an opportunity for you, Brad, is these transactions that occur, you know, whether it's a portfolio sale happening on some odd schedule basis, or, you know, we're 11 years into running our quarterly loan sales program, where every quarter we've got a variety of sellers bringing a variety of assets to the marketplace. So there's some consistency and some certainty to the timing of each of those. You know, we place a high degree of importance on security. We're going to track everything that, you know, we can from a diligence standpoint. Our marketing team is going to, you know, create as competitive a process as we can, and through that process, we believe that we will achieve market value. Now, whether or not that market value is acceptable, you know, to the Bobs of the world, is a decision that they have to make. They also have to juggle, loss reserves within the quarter and so forth. But, we'll agree to that price up front. We don't hit the price, you don't have to sell and you don't have to pay us, right? So your barrier to entry is low. So we're just trying to provide that consistent tool for him to go to as needed to have an option of taking those into a strategic loan sale. So, all right, a little bit of time here left. Bob, if you would give us just a little bit of a forecast here, next 12 months. What do you think are going to be maybe the types of loans, probably by collateral type, but you may have another consideration there. What are going to be the types of loans that you think would be most likely to maybe move into a loan sale transaction in the next 12 months?
Listening to Brad, certainly some of those loans where they relied on some of the COVID government money that are now experiencing difficulties. There can be small loans that the small loans, even for community banks that have scoring approved models. We've had a lot of success with approving loans that are scored, but our experience has been that when one goes bad, they go really bad, and right, and the ones that we've seen to have some difficulty with are little small trucking companies. Maybe it's just several $100,000. It's a guy that has a few trucks, maybe just a single owner operator. But what we found is that those are loans that typically, there's not been a lot of maintenance on the fleet, and so those are ones that we've kind of taken we've taken a more conservative. We're looking at underwriting them more stringently now. So that would be one side, and certainly we're also very careful on any acquisition and development lending right now in the residential space, even though there's not a lot of home inventory. We're pretty careful about what we're doing for to develop tracts of land to sell lots to build homes and that kind of thing.
Okay.
So,
okay.
Yep.
Brad, let's transition over to your side. So from the buy side, what are you thinking forecast for the next 12 months? What types of assets do you see flowing? What's that deal flow look like in terms of volumes, and do you anticipate any pricing trends?
I mean, we're still going to continue to see that large office, middle market type one-off loans. Those are going to happen for the next 12 months. The hotels that I mentioned, that are performing, that are kind of functionally obsolete, I think we're going to start seeing more of that. My bold prediction is going to be that you're going to start seeing some more multifamily properties come up, particularly in the Southeast and in the Southwest. Kind of your older 1970s vintage garden style multifamily properties where the maintenance wasn't, they just didn't keep the property up at all. Like I talked about earlier, and Bob has mentioned as well, your pre-2019 loans where the borrowers were having difficulties to start with, their COVID monies are gone. And so you're starting to see financial distress in the balance sheet. We feel like there's going to be a lot more of that coming out. The rolling stock, and Bob mentioned it again. We saw it earlier this year. I think we're going to continue to see that. Your smaller trucking companies, your smaller busing companies, where you've got tractor trucks that got 600, 700,000 miles on them, and you got another 200 till you got a major rebuild, and the guy hasn't kept up with capex. Essentially, you're gonna have big capex issues. So that's what we see, or that's what we're projecting to happen in the marketplace over the next 6 to 12 months.
Okay. All right. One more projection question, I guess, for both of you. As you guys both know, there was a big event last night. And I think we all know that I'm talking about the first college playoffs rankings that were dropped last night under our new 12-team playoff. Bob, Penn State grad coming in at number 6. Forecast would be, does Penn State make the college football playoffs?
I'd like to say that I'd like to say yes to that, but given our history in big games, I'm not optimistic. So I'm just not. I don't think that our team's really as good as everybody thought it might have been. Unfortunately, okay. Yeah.
And Brad, same question. Texas A&M, will they make the playoffs this year?
There's a distinct possibility that we might. I mean, South Carolina last weekend, the team came in flat. I mean, I really thought they were going to blow them out, and instead we got blown out. Our big test is coming up after Thanksgiving when Texas comes to Kyle Field. I'm expecting a victory on that. So I believe there is a chance, Jamie.
Looky there, full service sports knowledge along with risk portfolio management and loan sales. So, all right. So to wrap us up here today, guys, as we look forward towards 2025, landscape for performing and non-performing loans is going to remain complex and nuanced. While the commercial real estate sector, particularly office, is going to face some significant challenges in our opinion, residential mortgage markets appear to possibly be more resilient. However, some of the economic uncertainties, potential interest rate fluctuations, geopolitical factors, political outcomes from last night could impact performance of those loans across both sectors. So banks, investors, and policymakers are going to need to stay vigilant and adapt to navigate some of these challenges successfully. By implementing some robust risk management strategies, leveraging your advanced technologies, maintaining regulatory compliance, that we think these stakeholders will be able to mitigate the risks associated with both performing and non-performing loans to promote stable financial environments for 2025 and beyond. So the keys to success, in my opinion, are going to lie in the ability to anticipate, respond to changing market conditions, while also maintaining a focus on long-term sustainability and resilience and lending practices and just general resolutions of problem credits. And as the real estate and financial landscapes continue to evolve, those who remain proactive and informed will be best positioned to weather those potential storms and capitalize for some on those emerging opportunities in the years to come. So today, I've learned, Bob and Brad, thank you so much for participating with us here today. Really appreciate your time, really appreciate your insight. And on behalf of everyone at the team here with FFN, thanks to everyone who was joining us today, and be on the lookout for information on our next of the First Financial Forums. Thanks, everyone.
Thank you.
Thank you, Jamie. Bob,
Thanks, Bob.
it's been a pleasure.
Take care.